Investors poured nearly $200 billion into AI startups in just 5 years, chasing hype and profit at any price. Yet beneath the headlines, AI job postings are down 14%, and over 153,000 tech workers have been laid off since last fall. When the world bets everything on artificial intelligence, what happens if the money and the reality don't line up? The answer is already unsettling, and it's about to get a lot more complicated. Headlines in early 2025 painted a picture of calm. AI hiring was cooling off, with LinkedIn reporting a 14% drop in job postings from last year's peak. At first glance, this seemed like a healthy correction after a frenzied period of expansion, but the story behind those numbers tells a different tale. Since October, more than 153,000 tech workers, many in AI, have lost their jobs. Most of these cuts came from late-stage startups that had raised hundreds of millions but failed to turn pilot projects into actual revenue. The slowdown in hiring is not a sign of stability. It is the result of aggressive layoffs and stalled growth. For every flashy announcement of a new AI tool, there is a wave of engineers quietly updating their resumes, hoping to land somewhere less volatile. The optimism in the headlines masks a much harsher reality playing out in offices and Slack channels across the industry. Capital in the AI sector has pooled at the top with extraordinary force. Since 2020, more than 42% of all venture funding for AI startups has gone to just 1% of firms. These companies are often valued at 38 times their annual revenue or more, and they have become the poster children for a market where hype eclipses substance. Yet beneath the surface, the numbers tell a different story. Less than 14% of paid pilots for generative AI ever convert into full-scale, high-usage contracts. For many, the promised gold rush never materializes. The experience of Echo Wave, once the highest-valued voice AI startup, is a stark example. In March 2024, founder Jane Xu announced a $200 million Series B round. 14 months later, internal emails revealed a scramble to process refunds as enterprise customers bailed. 80% of Echo Wave's pilot users vanished after a single competitor slashed API prices. Refund logs show $9.4 million paid back in 3 months. For Jane Xu and her team, the gap between headline valuations and real lasting revenue was impossible to bridge. The cost was hundreds of jobs, years of work, and a wave of shattered expectations, and it spilled far beyond the balance sheets. China's approach to AI investment reveals a strikingly different risk profile from the United States. Between 2023 and 2025, Chinese state and provincial authorities directed over $60 billion into AI infrastructure and chip manufacturing, aiming to close the technology gap and secure domestic supply chains. This scale is hard to overstate. Entire industrial parks have been built around AI labs, with capacity often running ahead of actual demand. Yet when measured by capital intensity, the contrast becomes even sharper. The United States now deploys 71% more venture capital per developer in AI than China, favoring smaller high-valuation startups over sprawling state-backed projects. In China, policy-driven spending has created clusters of hardware and talent, but also signs of overcapacity, chip fab ghost towns where the investment outpaces commercial adoption. The question lingers: is it safer to bet on concentrated, high-stakes private capital, or on massive state-driven expansion that risks building faster than markets can absorb? Retail investors have poured billions into AI-themed funds, chasing the next breakout and fueling a frenzy that rivals the meme stock era. Trading volume in AI ETFs surged 340% year over year as everyday buyers scrambled to get in before prices ran higher. At the same time, valuation multiples for the hottest AI startups have reached eye-watering extremes. In late 2023, some foundation model developers were valued at up to 125 times their annual revenue, a level not seen since the dot-com bubble. But even these sky-high prices have not deterred capital. The cost to train a cutting-edge language model now exceeds $7.8 million per run, with cloud GPU rental rates are up 60% in just 12 months. To keep up, global spending on AI data centers and infrastructure is set to top $90 billion this year, with forecasts pushing as high as $110 billion. Each of these forces, FOMO, speculative valuations, runaway costs, and a relentless arms race in infrastructure, adds fuel to a market already stretched to its limits. More than 8 out of every 10 commercial AI decisions now rely on a single backbone. By September 2025, NVIDIA's Omni AI platform handled 83% of global cloud inference workloads, an unprecedented level of concentration. When the Cluster Z outage hit, the consequences were immediate. Over 18,000 businesses lost access to core AI services for more than a day, disrupting everything from financial trading to emergency medical triage. Within a week, Cluster Z's private shares traded 25% below their previous value, and public suppliers saw double-digit losses. For investors, the outage erased any illusion of safety. The system revealed just how fragile the AI engine really is. Carlos Ramirez, a senior engineer in Hong Kong, lost his job at Infinite Science when the company collapsed in April. He was one of 38 engineers let go as the firm entered bankruptcy, a casualty of tightening credit and regulatory pressure from the mainland. In China, regulators fined Baidu and Alibaba hundreds of millions of dollars for antitrust violations, wiping out over $40 billion in market value and freezing new investment. Hong Kong's AI sector unraveled in the aftermath, with Deep Vision and Siner AI shutting down and hundreds more workers out of work. The fallout left a trail of shattered startups and abandoned offices, a warning of how quickly confidence can vanish when policy, funding, and market trust all break at once. AI hype still drives billions of dollars in investment, but fundamentals lag. When capital outpaces real-world impact, risk multiplies. Today's bets shape tomorrow's fallout, and in bubbles, reality always collects its debt.